In part 1 of chapter 16, we talked about the differences between financial and managerial accounting. In this section, we're going to talk about how to compute and interpret income for a service firm from a managerial viewpoint. But before we do that, let's talk a little bit about how we understand various types of costs, because they make a difference to how we understand firm performance. A cost is a sacrifice of resources. It's a basic theory of business that every interaction is an exchange. You have to give up something in order to get something else. The thing that you give up is the cost. So, for example, I can give you money in exchange for your help, or I can help somebody in exchange for getting money. Similarly, I can give a supplier money in exchange for merchandise, or I can give a customer merchandise in exchange for money. In any of these examples, the thing that I give up is the cost of the transaction. The question that we have to deal with is how to recognize this from an accounting point of view. The word expenditure comes from the root word for spend, and it specifically means an outlay of cash. Whenever that happens to occur, it could be spending cash before you get some particular goods or services, or it could be in the moment, or it could be that you get the goods or services before you pay the cash, but when you pay it, it's an expenditure. The word expense also comes from the word spend, but it's an accounting concept that's ruled by the matching principle, which says that you have to match your firm's expenses to the revenues that they help to generate. Because of the matching principle, many firms, but not all firms, have two types of costs on their income statements: period costs and product costs. All firms have period costs. That is, the costs to keep the firm running in that period. And these costs are expensed in the period when they are incurred in order to follow the matching principle, to match those costs to the revenues that they help to generate in that period. So a firm's period costs might include its selling and administrative costs and its research and development costs. But many firms have another category of costs called product costs. Only merchandising and manufacturing firms have product costs, because these costs are attached to the units of inventory that the firm will sell to its customers. So what happens to these costs depends on what happened to the inventory. units of inventory that have not been sold by the end of the period have not yet fulfilled their destiny. Their destiny is to generate revenues for the firm, but that hasn't happened yet. So the goods stay in the warehouse, and the cost of those goods is capitalized. That is, it's turned into an asset and it's recorded on the balance sheet until sometime in the future when the goods are sold. By contrast, the cost of goods that are sold during the period is recognized on the income statement so that we can match the cost of those goods to the revenues that they help the firm to generate. As we go on with our work this semester, you need to be very sure that you're clear on the difference between an expenditure and an expense, and the difference between a period cost and a product cost. You can put most firms in one of three basic categories: service firms, merchandising firms, and manufacturing firms. The service firms are the ones that generate their revenue by doing things for their customers, providing them services. Manufacturing firms buy merchandise from somebody else and then generate their revenue by selling those goods to their customers. And manufacturing firms make the goods and then generate their revenues from selling those goods to their customers. Remember that service firms earn revenue by selling their time and their skill to their customers. So, for example, if you have a toothache and you go to the dentist may use some amalgam to fill a cavity in one of your teeth, but the dentist isn't selling you the amalgam. They're earning service revenue based on their skills. So for a service firm, all costs of running the firm during the period are treated as period costs, and they're recognized as an expense as they are incurred, that is, in the period when they happened. And that's following the matching principle, because we're matching those expenses to the revenues that they help to generate in order to determine how well the service firm did during the period. We tell that story on the income statement, and that story is all of the revenues minus all of the expenses gives us the firm's income for the period. Let's look at an example. In September, we're told that XYZ Company provided 1,000 units of service to its customers. And we're told how much service revenue the firm earned. And we're told how much selling and administrative costs the firm incurred. Of course, if this was a real firm, you'd have to go to various departments and find out this information for yourself. But on a homework problem or an exam, it's not a real firm. Somebody has to give you all the information that you need to solve the problem. In this case, we're going to use this information to prepare an income statement for XYZ for the month of September. Here's a form we can use to make an income statement for the XYZ company. I've already put down the heading for you, and you'll notice that it includes the name of the firm, XYZ, the fact that this is an income statement, and the period of time that it covers. That would be the month of September. It's a good idea to get in the habit of putting a heading on every document you create, especially accounting documents. Otherwise, you waste a lot of time searching for the right one. Now we can tell the story of what happened to this firm during the period. We were told how much service revenue the firm earned. We were also told how much selling and administrative expenses the firm incurred. In this particular problem, we were just given the total of the selling and administrative expenses. In a different problem, you might be given a list of these expenses, and you'd have to list each one and then add them up to find the total. Once you have the total selling and administrative expenses, you subtract that amount from the service revenue, and that gives you a number. That number is called operating income, the income that comes from the firm's regular business operations. If this financial statement was for external use, then you would have to subtract out the income tax expense for the period in order to arrive at bottom line net income. But for internal managerial purposes, operating income is generally considered to be much more relevant, especially since managers have no control over income tax rates. So, is this amount of operating income good news or bad news? And the answer is, it depends. It depends on how much operating income the firm was expecting to generate this month, and it depends on any changes in the economy or in XYZ's particular business segment. If the firm's service revenue or its selling and administrative expenses differ from what was expected for September, that's something that managers would want to investigate. Another thing that managers might want to do is to find the cost per unit of service for the period. To find that out, we would take the total cost, which was given, and divide by the number of units of service that were provided during the month, which was also given. The answer tells us, on average, how much did it cost the firm for each unit of service that the firm provided. And then the firm can think about whether that number is good news or bad news, depending on what they were expecting each unit of service to cost. If managers feel that this number is good news, they can think about what they can do going forward to sustain that level of performance. On the other hand, if it's bad news, then managers can think about what they can do to control the costs better going forward. This is the end of Chapter 16, Part 2.